Hello and welcome to the April 2021 Convergent monthly market and economic update. Today we're going to go through what we saw in April and how that relates to what we thought we would see coming out of our quarterly themes that we did at the beginning of April, as well as giving you some quick updates of what we're seeing here already in May. That knowing that by the time you view this, we'll already be in the middle of May, and just like we've seen in pretty much every month so far this year, at some point during the quarter or during the month, we've seen one part of the markets, whether it's the S&P 500, the NASDAQ, the small caps, have a pretty decent pullback, only to be brought right back up through the dip buying that we've been expecting to see all of this time. So right now in the middle of May, we're seeing a little bit of that volatility, but we still see this as currently as more of a episodic event versus something that's going to be turning into a major trend, at least here in the short term. So we'll definitely talk a lot more about that when we do our May update. But right now, let's jump into more information on what we're going to cover here in our April update. So first, we're going to touch on the market performance for April, and in particular, the areas that we thought would do well and how they actually perform versus the S&P 500 overall. We're also going to touch on a number of economic updates from unemployment to retail sales, GDP and inflation, and just give you a sense of how we see things trending based on, again, what we expected to see. And then finally, we're going to touch a lot more, again, on this idea of the death of the 60-40 portfolio and what true diversification really looks like from our opinion. So before we jump into that, let's just go over our investment philosophy. So again, it's really all about you and your investment portfolio living in alignment with your goals. We're also much more focused on, or at least as focused on, the why behind what you're trying to accomplish from an investment perspective, and not just on the how. And really, it's all about creating a personalized strategy that's going to answer a few really critical questions. Do you have enough? Is it in the right places? And where's the best place to take it from when you ultimately need it? Once we know these answers, that's when we can really create the ultimate optimal portfolio and, what we believe is a more truly diversified portfolio overall that we're going to get into a lot more here near the end of the presentation. So with that, let's jump into the markets. In April, really overall, markets were up and surged quite higher. And we've been anticipating this. We knew it would be very likely to happen in Q1, and we anticipated a similar outcome in here in Q2, as we believe we're in what we call our Quad 2 environment, which is accelerating GDP, accelerating inflation, which is typically a good environment for stocks overall. A lot of tailwinds going on with all of the comparables. This time, especially April of last year, pretty much the entire economy was shut down. And so we knew a lot of the year-over-year comparisons were going to be really good. And, even though that was expected, seeing those numbers come in, and many of them even better than expected, is really helping to drive the markets higher. We've seen good corporate earnings and just, I think, some confidence around the vaccine rollout and continued stimulus has also been areas that have been more supportive to the markets overall. So S&P 500 had a great month of April, up over 5%. We also saw a big rebound in tech, and tech sold off a bit in March and was actually lagging the S&P 500, but really rebounded there in April. So we saw a good rebound there and a lot of dip buying going on. A couple of the areas that we highlighted in our quarterly themes deck that we thought would do well would be financials and industrials. Industrials underperformed a little bit versus the overall market, up just under 4%, but financials did fantastic. We sensed that with rising interest rates, that's usually pretty helpful for financial companies, and so they actually did very well, up over 6% on the month of April. Another area that we continue to highlight, and that's been a big part of our portfolios so far this year, have been commodities. They continue to rise. The overall broad commodities index up over 8% for the month of April. And really, this is on fears of rising inflation that, again, now that you're seeing this all here in the middle of May, we've seen some of that come to fruition with some big numbers being reported so far in May from an inflation standpoint. So the commodities seem to have been front running that over the last 6 months, and we expect that to continue here in the near term. Also, European equities was another area that we thought would do well. We knew they were lagging the US and much of Asia in terms of coming out of the pandemic. And in spite of still some pretty strict regulations there when it comes to the economies opening up and being behind in terms of the vaccine rollout, the overall economic activity is picking up, and the markets there were up about 5% in the month of April. One of the areas that was lagging, though, was emerging markets. We anticipated that emerging markets that really had a commodity focus would do well. And many of those economies did. The overall emerging market index is very heavily weighted to China, and China is struggling from an economic and market standpoint. They were kind of the first that was coming out of the pandemic. And so we're kind of seeing them be the first that are starting to struggle because their year over year numbers aren't as quite as easy to beat anymore. And so that's really dragged on the overall emerging markets index. So on to some more specific economic data that we want to cover. While the markets have been performing well and many of the economic data points have been pretty good, there's still a lot of areas that are struggling and that we have some concerns around. First and foremost is total claims. While we've seen the unemployment numbers come down dramatically over the last number of months, we still have over 16 million people that are on some form of unemployment benefits, and which is dramatically higher than where we were before we started the pandemic. And so while we're seeing progress, there's still a lot of work to be done here, and that's really evidenced in the April jobs number. I think there was the big anticipation of having close to 1 million of new jobs created in April, just like 916,000, I believe was the consensus expectation, and we ended up just over like 266,000, so well below what was expected. And again, evidence that while overall things seem to be going well, there's still a lot of stress in the underlying economy overall, and especially related to jobs and the pressures around trying to boost the overall number of jobs. Some of the positives that we're seeing right now is the general consumer is feeling a lot better about the economy. Again, we think that's really related to the overall economy opening up quite a bit. And so we're seeing consumer sentiment begin to rise, one of the largest spikes that we've seen in quite a long time when it comes to consumer sentiment. And then another area that we're seeing really take off is retail sales. We've seen the largest jump in retail sales year over year in over 10 years, and really jumping, pretty easy to beat. I mean, really the economy was effectively shut down last April outside of, the big online retailers. And so this was anticipated that we'd see a pretty significant jump here, and we have. Another area that we anticipated being really well and going really well this quarter was going to be corporate profit announcements. And so far, we've seen over half of the S&P 500 companies reporting their earnings, and overall earnings are up over 50% from where they were at the end of the first quarter of last year. Again, this is anticipated. March was when the pandemic really got underway and where we started to see the impact on corporations being shut down. So this isn't a big surprise. We're likely to see very similar, even not better numbers reported at the end of Q2. That those earnings will begin to report it in July. So again, there's still a lot of tailwinds because of the level of earnings beats that we're seeing so far this quarter. Bigger numbers around GDP and inflation. We still anticipate a big rise year over year in GDP for Q2. We're anticipating over a 12% overall GDP growth year over year. We saw a big number also at the end of Q1, and so we're still anticipating seeing those. But as you're seeing on the charts here, we also do anticipate that we're going to begin to see a slowdown in the growth of GDP, or the rate of change. It doesn't mean we anticipate to see negative GDP numbers or negative inflation numbers. We just anticipate we're going to see a slowdown in the growth. And so same thing with inflation. We're seeing some of those numbers being reported here in May. We anticipate that the growth in inflation is going to slow down here in the second half of the year, just because the base effects, the numbers that are going to be compared against are going to be much higher as we get into later this year. And so while it doesn't necessarily mean that we're headed for an economic crash, it just means that it's harder to have as much tailwind when we're not seeing the same levels of acceleration of growth as we saw here in the first half of 2021. So with that, I think that's a good time to transition into this concept of the death of the 60-40 portfolio that we've been speaking to over the last number of months. We not only this year, but really over the last 40 years, we've been in this time frame where just diversifying with equities and bonds has been a great risk reward trade, again, over the last 40 years. But historically, we've not seen periods of time where that has persisted for as long. And even within this period of time where we've seen the market outperform, we had at least one stretch where there was a 13-year period where the stock market was effectively flat. And so while overall over the entire existence of the chart that you see here, the markets have generally gone up and to the right, so up over the long term, there have been periods of time where if that's when you retire, or if that's when you really need access to your capital, that there's periods of time where that doesn't work very well. And so you've seen, back in the 1930s, the Great Depression, but there ended up being a 25-year period where it took the market to get back to its high again. We saw a similar situation happen in the 1970s, and then again in the 2000s, including the great financial crisis of 2008 and 9. So there are periods of time where just diversifying with stocks and bonds isn't enough. And so, when we look at, what type of economy can we be in? There's really four main macro quadrants that the economy can be in. It can be in growth, which we've effectively been in for the most part over the last 40 years. We can be in decline, where the economy is actually shrinking. We can be in a deflationary environment, or we can be in an inflationary environment. And they can be mixed together to some extent as well. And we've seen all of these really, even in just the last year alone, as we went through the pandemic, we kind of went through all of them through that time frame. And the things that do well in each of these environments are different, or historically things that do especially well, or what you want to make sure you have in your portfolio. So in a growth environment, stocks typically perform exceedingly well. In a more deflationary environment, income typically does well. Bonds, because those have some level of a secured income stream, and as deflation is occurring, that yield you're getting becomes more dollars in real terms. On the flip side, when we get into inflation, you really want things that do well that in an inflationary environment, like commodities, like we saw in the 1970s, and commodity trend advisors that do well in those environments. And finally, when things are a little bit more haywire and the market is dropping and we're in a decline in an overall economy, things that do well in that volatile environment are things you want to have in your portfolio. And the reality is, we don't really know. Nobody has a crystal ball. We don't know tomorrow which of these environments that we're going to be in. So the reality is, if we're going to truly diversify your portfolio, it's important, in our opinion, to have pieces of all of these. The problem is, when most people think about diversification, they only think about it in terms of what's on the left side of this slide, which is mostly just stocks and bonds. And so from a stock perspective, if you have US large cap, some US mid cap and small cap, along with some international and emerging markets, you think you're pretty diversified from a stock standpoint. And if you have a mix of treasuries and some corporate bonds and maybe some high yield debt mixed in there, you think you're pretty well diversified from a bond portfolio. The problem is, when things get really volatile, when things are at their worst, like in 2008 and 9 and in March of 2020, all of the things that people are typically diversified into, including their private businesses, venture capital, real estate, all of those things tend to ultimately have a correlation of one, meaning they all go down at the same time. So even if you're overall diversified, your overall portfolio is going to suffer dramatically in that environment. So in our opinion, to be truly diversified, you have to add in these other quadrants. You need to have investments in volatility space that do well in that environment. Things like out of the money put options, some option strategies around the VIX, short futures. So there's a lot of different things you can do in that environment that do well when the market's at its worst. And also, again, in a very inflationary environment, having things, whether it's short, medium, or long-term trend following investments, especially focused on commodities, are going to do particularly well there. And then finally, the kind of underlying all of that is a risk of what happens if we inflate so much that we have a risk on our currency. Well, historically, gold has been a very good diversifier in protecting against a fiat debasement. So even having some level of that in the portfolio has helped as well. So that's what, in our opinion, an ensemble approach to having all of these components in your portfolio is becoming more and more important. Again, we've had this 40-year stretch where maybe you didn't need those other components overall, but we believe that, again, if we look historically, we're in a very rare situation where it's gone that long where these other environments weren't as present. And based on where we're going with the level of stimulus and just where the economy is going to need to go, we're concerned that we may be heading into one of these other regimes. We don't know, if obviously no crystal ball there, but because of that, it's important to have a fully diversified portfolio. Another way to think about this is, those as we look back at the last slide, the items on the left and the items on the right. The items on the right are somewhat negatively correlated with the stock market and the bond market. And so when we think about portfolio construction, you want things in your portfolio that zig when the other parts of your portfolio zag. And when you're opening up your statement, it's rare that you want everything in your portfolio going up at the same time. When you see that, the risk of that is it means all of it probably is going to go down at the same time too. So you want things in your portfolio sized right, allocated correctly, to make sure that overall you can smooth out your return, lower your overall volatility, and in an ideal world, because of that portfolio construction, create a smoother ride to overall a higher compound rate of return. And that's really the goal of our view on how we want to diversify our portfolios. So with that, in summary, we still believe in Q2 with a couple more months to go. We're still in this quad two, accelerating growth, accelerating inflationary environment, which still we believe at this point is still very supportive to stocks here in mid-May when you're seeing this video. However, we do have more of a cautious outlook going forward as we go into Q3, and a lot of it again is just that the headwinds are going to be there from these comparable numbers that right now are off the charts for Q1 and Q2 are going to be a lot harder. GDP is not going to grow as much year over year compared to the economy opening up last year. Corporate earnings aren't going to grow as much year over year compared to what they were doing in the second half of last year because the economy was beginning to open back up. So we do believe there's just a few of these headwinds that are going to create a little bit more concern as we head into Q3. And so it's not been a better time than now to consider a little bit different level of diversification in your overall portfolio, going beyond just stocks and bonds and looking at some of these other asset classes that historically have been great diversifiers, especially as we head into more volatile environments or as we head into a more inflationary environment, which many are predicting in the months and years ahead. So with that, that's our summary here for April. We look forward to going over the numbers for May here pretty soon, as well as some of the other education that we're looking forward to bringing to the table for you. So with that, as always, if you have individual questions on anything that we've discussed in this video, you just know that as a client of Convergent, we're going to be reaching out and discussing some of these strategies that we've been talking about today with you as we head later here into Q2 and anticipate some of that volatility ahead. And if you're not a client of Convergent and you're interested in learning more about these strategies, please reach out at any time. The info@convergentwealth.com or homer@convergentwealth.com. Great places to reach out, or you can call our main line at 253-236-7000.